Welcome back to Miller Momentum. Oh boy. It's one of my favorite times of the year again. Motley Fool's scare season. For some reason, they tend to put out a scrumptious fare of fear-mongering about the S&P 500 Shiller Price-to-Earnings ratio or CAPE ratio near the close of the federal fiscal year. It's like clockwork. Well, let's see what's on offer, shall we? But first, the usual disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. The stock market is on the verge of doing something that's never been observed in 155 years, and it has worrisome ramifications for Wall Street. A history making moment may be imminent for Wall Street. Unfortunately, it's not the good kind. Okay, so let's see. It's been a stellar last 17 years for Wall Street and investors. True. It gets into some indices, blah, 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 blah. And then it says the second priciest stock market in history is bordering on becoming the most expensive. Well, I mean, it depends on how you value it. I'm not going to argue that US stocks are cheap or anything like that. Certainly not. But um, you can't use the same metrics to value stocks now as you used to back then. And I'll get into that later. So, at least Motley Fool does admit that valuing individual stocks or the broader market is tricky. The way that a lot of people do it is through the Shiller Price-to-Earnings ratio, also known as the cyclical adjusted price-to-earnings ratio or CAPE ratio. See? CAPE. CAPE. Anyway, so whereas the traditional price to earnings ratio accounts only for 12 months of trailing earnings per share, that's true and can be tripped up by recessions. Also true. The CAPE ratio is based on average inflation adjusted earnings per share over the trailing 10 years. And that's true. So it retains usefulness on a longer scale. Um, I wouldn't say any economic climate. And while it is factual that the Shiller PE ratio is now just about 3.5% away from passing the dot-com bubble, I mean, that's true. But again, um, okay, so this is where the article really starts tripping up because it applies the CAPE ratio back in time to 1871. Well, software companies, railroad companies, and manufacturing companies are very different creatures. And whether or not they're expensive is, well, you're going to arrive at a very different answer just based on their operating costs and equipment and whatnot. So now it says there's been 6 instances, including the present, during which the Shiller price to earning ratio has exceeded 30. The previous 5 were all followed by declines of 20% or greater in the benchmark index or its peers. So, hmm, see, this is where I really want to get into challenging some of these claims because while this is true, this is kind of seeing a pattern where there's not necessarily one. I mean, the CAPE ratio is extremely ineffective for market timing or tactical shifts. So a reading over 30 indicates high relative valuation. That's true, but multiples can remain elevated and expand further for years. And so they cite, for instance, 1997 to August 2001, and the aforementioned highest ever reading came a few months before the dot-com bubble burst in March 2000. Well, yes, but here's the thing that the article doesn't state. 1997 to 2000, the CAPE ratio actually crossed 30 in June of 1997. And then the S&P 500 proceeded to gain roughly 75% over the next 3 years before it peaked in March 2000. and even losing, you know, 49% of its value, you still came out ahead if you were investing in 1997. And again, they mention August 2020 to May 2022. The Shiller price to earnings ratio was a hair above 40 for a few days. Well, that's true, but the market still didn't peak until January of 2022. So exiting risks asset based, it's just, it's not a good thing to time your exit using the CAPE ratio. I mean, generally it's just not a great thing to exit the market at all. The old saying is time in the market is way better than timing the market, and the math is unambiguous on this. But yeah, if you had exited when the CAPE ratio first started looking a little wonky in these scenarios, then you would have missed out on gains, and you would have still probably been hit by the dip unless you went into cash only, which again is not advisable. Let's see. Not that I can give financial advice, but I'm just saying it's not advisable. I don't do it. The other thing that the article does here is it cites December 2019 to February 2020 when the CAPE ratio passed 30 in the months preceding the COVID-19 crash. But this is a little unfair, right? Because it's saying that this is evidence that the CAPE ratio foreshadowed a 20% plus decline, and then the ensuing 34% crash came. But that was the direct result of a global economic shutdown triggered by the COVID 19 pandemic. And it's just bonkers to attribute an exogenous biological shock to a valuation mean reversion. It's just an inductive fallacy right here. And it's not like stocks were soaring high on the AI craze, because this was back in 2019 and 2020. We didn't even know what Chat GPT was back then. So this time-tested valuation tool leaves little room for interpretation. Woo! Yeah, no, there's a lot of room for interpretation. Room enough to drive like a truck through, or a semi truck, or a battleship, actually. Um, Premium valuations aren't tolerated over an extended period on Wall Street. Oh gosh, yes, they are historically. Um, but yeah, so this is just kind of whack. But let's keep going through the article. So, if history were to rhyme on Wall Street, significant declines should be expected for the Dow Jones Industrial Average, S&P 500, and Nasdaq Composite. Although I will add that declines in those different indices are not going to look similar to each other. For the AI bubble, at least, since it's centered in tech, it'll probably hit the Nasdaq 100 really badly. May hit the S&P 500 moderately badly, but Dow Jones Industrial Average, it'll drop, but I don't think it'll be as bad as a lot of people make it out to be. So let's see. Yes, stock market corrections, bear markets, and elevator down moves can be scary at times and tug on investors' heartstrings. That's very true. It's never fun seeing red arrows in your portfolio. Very true, unless you're kind of insane like Warren Buffett, where he sees that as a buy signal. But hey, I mean, if you're going to buy individual stocks, which I really only do with fund money, because the mathematics is, again, very clear that that's a great way to lose money. But if you're going to do it, then red arrows are a great time to look for value deals. Companies with solid fundamentals that are down because the market is just getting something terribly wrong about them. Anyway, since moves lowers are commonly driven by investors' emotions, no amount of fiscal or monetary policy maneuvering can prevent corrections, bear markets, or crashes from taking place. Not necessarily true. The Great Depression crash resulted in a whole ton of regulations, especially around leverage. So it's highly unlikely a crash like that could ever happen again with our current financial infrastructure. So, yeah, there's ways to actually uh, protect against emotional trading. Uh, the crypto market doesn't use them, but the regular market does. Let's see. Recently, Bespoke Investment Group published a data set to social media platform X that compared the calendar day length of every S&P 500 bull and bear market since the start of the Great Depression in September 1929. This comparison featured 27 full separate bull and bear markets. Okay. On the one hand, let's see the average S&P 500 bear market over the last 97 years resolved in 286 calendar days, or roughly the equivalent of 9.5 months, and that's true. We've also never witnessed a bear market endure longer than 630 calendar days. Oh, that's not necessarily true. I mean, it depends on how you define a bear market, because the year 2000 to 2010 is referred to as the lost decade for a reason. The S&P 500 was just trading sideways the whole time, so I'd consider that whole decade a bear market for the S&P 500, and that's much longer than 630 calendar days. That's a decade. And that's just one example. The 1970s is also a good example, because even though the S&P 500 had okay nominal returns after adjusting for inflation, it was flat or negative for the whole 10 years. So this is just kind of a false statement, but they probably define bear market in a tautological way so that um, it means whatever they want it to mean. Let's see. In comparison, the typical S&P 500 bull market has persisted for 1,023 calendar days. I'm not going to really believe a lot of the statistics on this page after that. I mean, the longest bear market being only 630 calendar days is laughable, especially if they started from September 1929. Um, I'm pretty sure that we can classify the whole 1930 to um, uh, the math 1942 span as pretty bad. Anyway, so let's see. All right. Well, that's the article. Thank goodness at least that they didn't end it with, but that's not even one stock that we're considering. What if we told you these other stocks are doing even better? Subscribe now. Behold the Motley Fools bear market that only lasted 630 calendar days, all the way from September 23rd, 1929 to about June 30th, 1944. Yeah, that's a whole lot longer than 630 calendar days. Oof. All right, so let's see the 1970s. I also mentioned that. And I don't like to just toss out numbers and say, oh, yeah, the market was bad during this decade. Trust me, without actually bringing receipts to the table. So let's go ahead and do that. All right. So we want to go all the way to 1981. Let's do 83 just for context. And the 31st. And let's go. Yeah, that doesn't really look like a bear market, does it? But watch what happens when we do adjust for inflation. Oops, wrong button. Adjust for inflation right there. Oh, geez. So, adjusting for inflation during the 1970s. See, I told you, here we've got another decade that, well, I wouldn't really consider that a bull market. Maybe a drunken bull market. Maybe a bull market where you're a matador running away from a bull that got out of the arena. But yeah, not a bull market. So now that we've got the bad math from the Motley Fool out of the way, let's return back to the CAPE ratio and actually dig into the good information on this and talk about its limitations, which a lot of people really don't understand, especially finance influencers on YouTube. So, bottom line is comparing today's CAPE ratio to a 155-year historical average of 17.4 is an apples to oranges comparison. The quote unquote normal CAPE baseline is structurally higher today for three mathematical and compositional reasons. So, first is the index composition itself, right? So the 19th and 20th century markets were dominated by capital heavy, low margin railroads and industrials. Today's S&P 500 on the other hand is weighted heavily toward asset light, high margin technology monopolies that naturally command higher multiples. The second thing to keep in mind is share buybacks and dividends. So, historical companies return capital primarily through dividends. Modern firms, however, favor share repurchases and they favor them heavily. And there's some tax reasons for this because, well, if you do share repurchases, you increase the value of your shares for your shareholders without forcing them into a taxable event with dividends. I did a video on dividends. Go check it out if you want to learn more about that. Well, anyway, buybacks reduce outstanding share counts and they mechanically accelerate earnings per share growth. So the standard Shiller CAPE does not adjust for this shift. And that means that it artificially inflates modern CAPE readings relative to historical ones. So even though we're approaching the highest level for the CAPE ratio in history, it's kind of an open question about whether that's even meaningful. If we adjusted it with some alternative measures, then hey, maybe we're not in the most expensive market. Well, not yet, at least. And then, of course, there's the third reason, which is GAAP accounting changes. And I'm talking about GAAP. So, modern accounting standards, for example, strict fair value goodwill impairment rules introduced back in 2001, are more conservative. They often depress reported earnings during recessions via write downs, but do not allow for upward revisions during recoveries. And that structurally lowers the 10-year earnings average used in the CAPE denominator. So while a CAPE above 30 mathematically correlates with lower annualized returns over a forward 10 to 15-year horizon, using it as a tactical signal for impending market doom ignores the structural evolution of public equities themselves. And so it's just not really a good signal for whether the market's in a good place or not. How then do we know if the market is not exactly doing okay? Well, there will be signs. One of them is things like people talking about data centers in space. No, I'm serious. Not about data centers in space, but you've got to look for qualitative signs about where the market is going because the thing about um, technical analysis and things like the Cape Shiller ratio and stuff, they can be useful in limited contexts. But if you're looking for a big crash, then, well, I'm sure some of my viewers have probably heard about Goodhart's law, which essentially says that as soon as you come up with a metric or a target, people start gaming it, which is fairly true. You can't game things like factors or momentum, but you can definitely game things like um, particular measures of revenue or particular measures of profitability or particular measures of value. That's why factor researchers they constantly update things and measure aspects that go way beyond the common technical analysis tool suite. But yeah, data centers in space sounds kind of bonkers. Probably a bubble indicator. Or more down to earth qualitative signals like credit downgrades and accumulation of massive debts accompanied by negative cash flow. That definitely spells troubling times for different companies. So, what should retail investors do? Well, I think nothing, actually. If someone is investing in broad index funds or quantitative factor funds across uncorrelated asset classes, well, market crashes are ultimately just big volatility dumps to be harvested and converted into returns over a series of years. One of your uncorrelated sleeves buys the other. You it sells the top, buys the bottom. It's just part of rebalancing. The worst idea probably is to sell out into cash and succumb to fear. I'll conclude today's episode with a cautionary tale, a story that I saw on Benzinga about some kids. Their dad told them to pull out all their money in 2025 because the stock market was at historic highs, and now they're afraid to get back in because the market is hitting new highs every day. So, first of all, historic highs don't really mean anything because every new high is an all-time high. And in a later video, I'll show you some interesting random walk simulations and such, and show you that sometimes buying at what is the top has a higher upside than buying at a dip, because the behavior of the S&P 500 and other broad markets can be somewhat random. So it really doesn't matter where the curve is when you buy in some cases. Now, that's not to say that, if there's a great financial crisis and things crash 68%, well, yeah, duh, that's probably a great buying opportunity. But people who wait for a good entry point for the market, there's always a reason to convince yourself that it's not the right time to get in. And then before you know it, years have gone by and you've missed out on so much opportunity. Again, time in the market way better than timing the market. Back in 2025, these kids pulled stuff out because their parents told them to. They were scared, and this happens all the time. One adage that I heard is, "What's the best time to invest? Today." Um, you know, what's an even better time to have invested? Yesterday. All we have is the present. And if you are confident in your portfolio design, then ideally it shouldn't really matter when you put money in, because in the long run, things balance out. Thank you for watching Miller Momentum. Hey, if you enjoyed this video, don't forget to like and subscribe. Not that it should matter much to long-term investors with balanced portfolios across different asset classes, but do you think the US tech sector is in a bubble? It's sure fun to talk about. Do you think all this AI stuff will actually pan out, or is Ed Zitron right and it's just all overblown? Let me know down in the comments.